Back underway. One of the other very unique and very innovative structures in transactions is looking at representations and warranties insurance. And we're very pleased to have one of the most renowned experts in reps and warrants insurance here with us today. Matt Heinz leads the practice nationally for Aon and is really a leader in this space. And this is one of the very sort of new and unique structures that helps bridge the gap, as we've termed it in the program, between valuation, when you start to look at risks and structures to incorporate those into the deal and manage those. So with that, let Matt Heinz introduce the rest of the panel and walk you through some of the really innovative and new things that are happening in reps and warrants insurance.
All right, thanks so much. So welcome to the Transaction Liability Insurance portion of the program. Thanks for joining. Please take out your 3D glasses and helmets. Joke. So last year I was up here and I went through a pretty detailed sort of description of rep and warranty insurance, tax liability insurance, what it is, how it works, how the process is undertaken. This year I'm lucky to be joined by two colleagues of mine with whom I work. Ben and I are working on a deal right now for a client. Phil and I got off an underwriting call 90 minutes ago. So it's very topical. We've got a lot of deals going on. I want to ask Phil and Ben if you want to just introduce yourselves, let everybody know your roles, and we can sort of jump in.
Sure. My name's Phil Casper. I'm a vice president in AIG's Mergers and Acquisitions Insurance Group. I've been underwriting these products for just over 3.5 years now, and before that I was an attorney at Schulte, Roth & Zabel.
Benjamin Klinger. I'm a partner at Kirkland and Ellis. I went down to Houston about 10 months ago to open our practice there. And a little plug for that, we're now about nearly 40 attorneys. Most of us focus on energy, but we also do your typical middle market private equity stuff, which is kind of Kirkland's claim to fame.
Yeah, so rep and warranty insurance, hopefully most of you in the room are familiar. Like I said, we're going to skip past sort of a real bare bones sort of description of it. We have seasoned M&A folks in the room, so hopefully most of you at least have some idea what this is. Rep and warranty insurance, as the name would imply, covers liabilities arising out of breaches of reps in the deal. It's actually not a new product. It's been underwritten in the U.S. for the last 15 years or so in sort of a formal way. There were one-off deals that had been underwritten back into the 90s. The product formally was introduced to the market in 2000, 2001. Sort of chugged along for a while, modest success, experienced some greater success in the private equity sort of boom years, 2005 to 2007. We started to gain some traction, but the knock was always that the insurance was either too expensive or the coverage stunk, and it wasn't going to get a buyer or a seller back-to-back enough coverage with the traditional indemnity that you'd see in a deal. Recession hits, 2008, market falls off a cliff. There were basically three of us on the underwriting side at that time. I underwrote before coming over to Aon. And due to competitive reasons, we slashed price. Whereas we were formally pricing deals at 4 to 6% rate on line, meaning 4 to 6% of the amount of limit of liability that you're buying. 2008 hit, paucity of deals out there, all of a sudden we were writing deals at 2 to 3%, okay? Basically cut the price in half. As we emerged from the recession and deals started to pick up again, that 2 to 3% pricing all of a sudden resonated with folks. And they started saying, well, this now makes sense to me on the pricing front. Let me see how I can get the coverage expanded so that this is a viable solution for me. Fast forward 2 or 3 years, all of a sudden folks are using the insurance strategically as opposed to reactively. 10 years ago, we'd get calls on the underwriting side when there was an adverse diligence finding on a deal, or there was an impasse between buyer and seller over indemnity amounts. Nowadays, and this is the first question that we're going to get into with Ben, folks are using the insurance much more proactively on the front end of a deal to sort of structure the indemnity or massage the indemnity to gain some advantage, either on the buy side or the sell side. So Ben, first question for you. Current client view, both buy side and sell side, on the use of rep warranty insurance. What are the advantages to be gained?
So interesting, you were talking about kind of going back, and I remember thinking about this product for a very long time. Starting conversations with a client saying, what do you think about using rep and warranty insurance here? And usually the answer is like, no, we're not going to do that. We're going to do traditional indemnity. But the period of time you talk about, 2006, 2008, and then now again, last 2 years, right. What do they have in common? Very frothy seller market, right? So things get more competitive. We'll talk about this a little bit later with strategics, but things get more competitive. People try and find other ways to do deals, and also that they just really have no choice, right? So What used to be I almost never saw it. Now you'll see almost in every bid draft, we're contemplating the buyer using rep and warranty insurance here, or sometimes you'll do what we call like a stapled policy, stapled financing. They don't give you the full policy, and there's certain other dynamics that are at play there because firms like Kirkland, who've been working with the major brokers and the major underwriters like AIG, have developed policies over time. And these policies are proprietary, let's say, and not to be shared with buyers when you're on the sell side.
Right.
So you don't necessarily staple a policy, but you'll staple terms and things like that. So these days, in terms of how do I think about it and how do our clients think about it, certain clients have gotten more comfortable over time. They'll do it almost every deal.
So I mean, the idea is when a buyer is approaching, usually in an auction, and private equity have really driven this business more so than the strategic side. When you're in an auction, you can basically offer a seller a minimal indemnity cap, right? As opposed to a normal 10 or 15%, let's say, indemnity cap on the breach of rep exposure. A buyer can walk into an auction, offer a seller 1% indemnity cap, insure themselves up to that more normalized level, and effectively offset the cost of the insurance against their valuation. So you shift the cost to the seller, whether or not the seller knows it. You're offering seller a much lower indemnity package than presumably the rest of the field, although I think that first mover advantage has sort of gone by the by.
It is.
But you produce a better bid, a better
And
offer.
the other key piece to why it actually works or why it's effective is that often sellers tend to overvalue their risk, right? You sit on the sell side and you're like, I've got 10% exposure. Well, they tend to, the expected cost of that, the way they think about that tends to be higher than the cost of your premium. So it tends to make sense to them. They say, oh, that's great. I was on the hook for $10 million, and they don't think of it as like, well, gee, 1 in 100 deals results in a claim. Therefore, this is really only worth $100,000 or something like that, right? In terms of expected cost, they think of it like a real possibility they could be out that money. So when you're able to walk in the door and offer them that, and then some of the other key pieces like certainty to close, which is, again, something in a frothy seller market that people pay a lot of attention to, it's really compelling. And add on top of that the fact that everybody else is doing it, it gets a lot more people comfortable with it. And then the more they use it, it's kind of like once you've used it, then they'll comfortable doing it again and again and again. But it was getting to that first.
Yeah. So that seller overvaluing of their risk, by the way, is what led to the current sort of seller flip model. So what we do a lot of times for sellers as opposed to buyers is we'll go out and price out insurance on the front end of a deal for the seller. They will figure out what roughly 10% or so of the anticipated deal size would cost to place in the insurance market. We'll put together a proposal for them when they send their bid draft of the SPA and all the preliminary documents out to their field of bidders. They'll tell those bidders, look, I'm only agreeing to a 1% indemnity cap on this deal, or 50 basis points, some minimal number. But I've gone out and priced insurance for you to cover you up to 10% or 15%. Here's what those results look like. We've already got, it's not stapled because the underwriting still needs to be done. It's basically an offer of to underwrite insurance, but they're basically leveling the playing field and telling all buyers, this is going to be your sole source of recourse, or the source of the majority of your recourse post-closing. And the seller, by doing that, is able to exit the deal with 99 cents on the dollar closing, right, unencumbered by a potential breach of rep claim, down the road. So.
And that's not to be said. It's not to say that if you come in with a strong enough bid, you wouldn't, win the bid without it. But if you're competitive on price, everything else being equal, it'll definitely be a disadvantage if you're not using it.
Phil, did you have a note?
Yeah, I guess one other element that I think is attractive to sellers is there's a bit of an arbitrage element in it too, right? Because in a typical structure, you would have to put that piece of the indemnity into an escrow for a year or 18 months, and it's going to be earning minimal amount of interest. Instead, you get to free that up down to a 1% indemnity. You get that $9 million back, and you get to get it out to your LPs or reinvest it. And you can almost certainly earn more than that minimal amount of interest. So.
That's right. Assuming a reasonable rate of return, it's always cash accretive to a seller to get as much of that cash out at closing and pay that. The value of getting that cash out is going to exceed the cost of the insurance in virtually every circumstance.
And one other point on the strategic uses point. So now you're assuming that everybody starts to use this product. Now the play is, well, how do you think about kind of dividing up what risk remains? So again, you're back to this way the sellers think about risk versus the buyer. So these days, I often advise my clients to trade theoretical risk on the retention part. So the retention part of the policy is your deductible essentially for the premium, which is real cash up front, right? So I'll say, well, hey, why don't we split the premium with you and we'll split the deductible or retention? Or how about we take all the retention, which is going to cost us a little more on the retention maybe, and you guys pay the premium, which is real dollars up front. So yet another way to kind of, and if you're a seller, as irrational as it may be, that may make sense to you.
Yeah. So we're going to move on now. As I mentioned before, part of the knock on the coverage historically was, on the one hand, too expensive. On the other hand, the coverage was viewed as somewhat lacking. And again, once we got past that pricing hurdle, we worked with folks like Kirkland. We on the brokerage side, amped up our requests of the underwriters on, on coverage terms. The coverage started expanding and getting more back-to-back with a traditional indemnity, with what a buyer would expect to get out of an indemnity from a seller. So Phil, do you want to just talk about some or share your thoughts on, I think it's very relevant for you to say it because you're the ones, you guys on the underwriting side are the ones who've gotten comfortable providing this expanded coverage. What are your thoughts on how coverage has expanded and sort of what insureds can expect?
Yeah, I think without a doubt, it's pretty clear that if you looked at a policy that we underwrote in 2011 versus a policy that we would be underwriting today, they would look night and day. If you ran a red line, there'd be red and blue all over the place. And it's pretty much all to the insured's benefit. Yeah. So the key changes that have really made a big difference in why people are interested in buying this policy. We mentioned it's a frothy market, and the other thing that's happened is we've matched up a lot better with what you would get from a seller in a typical arm's length indemnity negotiation. So we used to have exclusions on almost every single policy we wrote for consequential and multiplied damages, and as you guys know, that's typically a source of contention between buyers and sellers, and buyers always want that. We've gotten a lot more comfortable over the years based on our loss history and just the makeup of our book that that's a type of coverage that we can provide to buyers, and I think that really spurred a lot of the growth as well because people realized we're getting a lot closer to what you can actually get from a seller.
Right.
Well, if not, I mean, not to bite the hands that feeds me, but if not better than you can, especially with survival periods. And I mean, there's, knowledge, how we think about knowledge and how it's defined, materiality scrape in every deal. There's certain things, I know it's pretty technical what I'm saying, but there are certain things that and again, it reduces transaction costs, right? So if you don't have to argue about these things, all of a sudden you don't have to pay your lawyers to do that.
Yeah, that's a really important point. I mean, I think people should understand, on deals that feature insurance in the current market, you're more likely to see, even though it's such a strong seller's market right now, you're more likely to see a buyer-friendly contract at the end of the day because the insurance is involved. And Phil and the other underwriters, I mean, the former M&A lawyers, by and large, they're not stupid. They're looking at how many deals are you going to look at this year, Phil? 1,500 or something? They know what a market set of reps looks like. They know what a market indemnity looks like. But because they've gotten more comfortable with this expanded coverage, they're able to provide a buyer, an indemnity package that would take a, hand-wringing negotiation with the seller to achieve. And they're comfortable doing that with, a modest retention in there and for the amount of premium based on their loss history and their view of where the claims are coming in. But as Ben mentioned, it's reduced transaction costs. You don't have to fight with a seller as a buyer over every materiality qualifier, over every knowledge qualifier, over, whether you're going to have a scrape. In the deal. The carriers can do that, and they can provide that coverage pretty readily these days. There's a cost to everything, so Phil will negotiate. He's a good negotiator, but they are able to provide buyer-friendly, coverage terms.
Yeah, that's right. I like to call it, you get to save your bullets for things that you care about a little bit more.
Right. So to the other end of the spectrum, Phil. Current market on coverage and terms. What are you guys not willing to do? Where are you still drawing the line on risks that are not you deem not appropriate for the insurance market?
Right. I think the main thing that people sometimes have a tough time getting their heads around, or just understanding the concept of, is our knowledge exclusion and just how we think of things that buyers actually know about. So this is an insurance product, and it's there for things that may come up in the future that are unknown liabilities. So if you know about something and you're a buyer, you're going to have to figure out a way to either take on that risk on your own or figure out another way for the seller to take on that risk. The insurance company, there may be other products that can address the risk, but a reps and warranties insurance product is not the way for you to get coverage for that.
So let me actually just take a step back on that. Every one of these policies has a knowledge exclusion on it. It's basically an anti-sandbag exclusion. U.S. deal, typically pro-sandbagging, jurisdiction. You as a buyer are accustomed to being able to bring whatever claim you want, whenever you want, even if you knew about it before you closed. That's the way a lot of most deals go. This is an insurance policy. I'd be lying if I sat up here and told you that everything that's indemnifiable within a deal is insurable. That's not the case. There are certain things that are just not going to be insurable. These policies are designed to cover the unknown. So unknown breaches of reps and warranties that are discovered post-close. Most folks can wrap their arms around that. Years ago, again, when the coverage was sort of in its infancy, we had a knowledge exclusion on these policies that read knowledge of any facts or circumstances by the insured defined that could reasonably give rise to a breach will be excluded. So every lawyer that we talked to immediately puked on the table when we go into a pitch and say, thanks, that's not where the paper it's written on, and there's the door. So we narrowed that down over the years. I mean, the actual knowledge standard now is really based on actual knowledge. It's actual conscious awareness of a specific set of individuals at the insured. It's usually the 3 or 4 folks who are really in charge of the diligence process or on the sell side in charge of prepping schedules and negotiating the reps. Actual knowledge, actual conscious awareness of a breach, of the thing that causes the breach, and that the thing is a breach of the agreement, will be carved out. So it's not quite a fraud standard, but it's pretty close to a fraud standard these days in order for that exclusion to apply. So it's not like the carriers get to sort of go back and play Monday morning quarterback and say, well, on page 5 of your diligence report, there was reference to a potential tax issue. That's not the type of thing that's going to be excluded by that. You have to know that there was a breach of the agreement.
Yeah, and you think about it, these things, we try to have these things end up with the true north, right? That's the fair result. That's what it should be. Right. That's the whole purpose of it. And I think the other interesting thing about this, and we talked about this a few weeks ago at another event we did, was the only way this works, and Phil knows this as well, the only way that this works is if everybody recognizes this kind of repeat players in this, right? You're going to do it over and over again. So taking advantage of it one time to be clever is not going to be to your advantage.
Right.
Because the next time you do it, it's going to be an exclusion, or they're going to not trust you.
Right.
And that works across the board. So I think that's also, to go back to the earlier point, that also has led to more and more people using them.
Maybe both of you guys could comment on sort of timing of deal process versus the underwriting process, because that's raised a little bit of ire with some investment bankers that we've worked with recently who sort of want, they effectively want or pitch to buyers, a scenario where, look, submit your bid on Wednesday, we're going to pick, with your contract marked up that you're ready to sign, and we want, the deal done and signed that night. We're going to pick the contract that we like and the deal that we like. That's a different model than the way our underwriting process works. I don't know if you want to dive into that sort of pre-exclusivity underwriting and what you can and can't do.
Sure. So our stance has been, and I think it will continue to be for the near future, that we're not going to go into underwriting with a buyer until they're an exclusive bidder in an auction. We don't have the resources to go down the road with a bunch of different bidders before they get exclusivity or before they're done with their due diligence. We have to hire lawyers for each bidder, and we would have to set up confidentiality trees and just keep everything separate from each other, and it creates a bunch of logistical issues.
Right.
So we've never figured out a way to profitably underwrite deals unless we've got one bidder and we're dealing exclusively with them. So that has created some friction with bankers who want to create as much froth as they can and get as many bidders as far along as they possibly can and get as much out of them as possible. I think at the end of the day, we're providing a pretty significant benefit to the bankers, sellers, and to hold up. Our underwriting process has gotten a lot faster than it ever was. It used to take, even before Matt was working in our group and doing the underwriting, it would take as long as a month to underwrite one of these. we're in a position where we can get these done in 2-3 days. If we're working really fast, and we'd like to have a week, but to be able to get 3 days to get a policy underwritten correctly and well, I think is an okay price to pay.
Yeah, and a couple of points on that. So I want to be clear, we are able to get quotes, right, within 3 or 4 days, and you will have a sense of what the insurance market will bear. You don't need to be exclusive to get that. You can be one of many bidders going out and looking for different insurance parameters on the same deal. And with a SIM, audited financials, and any kind of draft of the acquisition agreement, we can get you quotes. So you have some sense of what the market will bear. What Phil's talking about is sort of the horse that you're going to run with, sort of the one bidder who's basically won the deal, and then the carrier gets into their phase 2 underwriting. And they're hiring their lawyers, bringing in outside counsel, getting into the data room, and really underwriting the deal in 3 or 4 days to get to a bindable product. So, okay, thanks. So I want to be clear about that. We can get market information for you and put that in front of you, at any point. But in order for them to get into their real nitty-gritty underwriting, it's going to be, you need some level of exclusivity. Okay. Any other thoughts on diligence process, underwriting issues versus policy exclusions? I mean, to me, that's where the real rubber hits the road on every one of our negotiations. The carriers will produce a quote that's, they're going to stick to, but there's always going to be something in underwriting that might be an issue or that might be potentially excludable, and that's what we have to work through and really negotiate with Phil and with Ben. What are your guys' thoughts on that?
Yeah, I think we try to cover the reps as negotiated between the buyer and the seller to the largest extent that we can. The things that concern us and the things that we don't love covering are sort of risks of the business going forward. So in a financial institution, if you've got representations as to the adequacy of their reserves for losses or something like that, that's something that we don't love because it really causes us to get out our crystal ball and try and figure out what those losses are going to be, and that's not something that I'm smart enough to figure out, unfortunately. Collectability of accounts receivable, those are the types of things that we will exclude. And sometimes there's just business activities that we haven't figured out how to underwrite profitably. So the main one that I think is causing some folks consternation is Medicare, Medicaid collection practices. Mm-hmm. There aren't really any insurance markets out there that provide coverage for that. Mm-hmm. And
it's a very rare circumstance, and we can occasionally get it done, but it's a rare circumstance to get true significant reimbursement risk covered in a healthcare deal.
Yeah. But other than that, I think we have a pretty broad and healthy appetite for most industries out there, and we like looking at different industries. It's part of the fun part of the job. And
yeah, a couple things there. One, I see more and more. I don't know how you see it, but like wage and hour stuff in California. Mm-hmm. That's another one that you guys hate because like California is just all over it all the time, so people get nervous.
So 2 claims come in on wage and hour stuff last week on separate deals. I mean, it's just the plaintiff's bar in California is out of control.
Yeah, so they get pretty nervous about that. Another one I saw about a year and a half ago, I did on the flip side to show how flexible folks can be. It wasn't one of those deals, but with another carrier we use, or underwriter we use quite a bit. There was they had a factory in Mexico, and there was believe it or not, kidnapping and ransom rep, first one I've ever drafted, and the sellers were like, it was a very interesting negotiation. I won't get into the weeds, but we ended up getting coverage on that. It was a big enough deal, I think, that it made sense. But that's a perfect example of also, and I think another thing that's led to this happening in 2 or 3 days is the relationships that the law firms that have been using this product and the underwriters have developed over time. So that one, I literally was on the phone talking to them and saying, listen, we've done X amount of deals together. Like, this is how I think about this, and got them comfortable. And I'm sure you've had that conversation numerous times, and you rely on our diligence memo, and it's like, look, Kirkland's doing this. We expect a certain level of work product. We're going to rely on this to some extent, even though we say they can't rely on it. They are relying on it to some extent. to get comfortable and recognize that it's repeat players in the same industry, and we want to continue to use the product.
Yeah. Yeah, I want to make sure that people are clear, too, on sort of the growth of this business. I mean, a few years ago, we might have been able to get a deal done in 2 or 3 days or over a weekend. I had circumstances where I got a call on Thursday from a banker, and they said, I need Thursday night, we need the policy done by Tuesday, and we were able to, accomplish that. The market is much different now. I mean, when I left AIG in 2010, we were on track that year when I left in August to see something like 110 submissions, 115. Last year, what did you see, 1,400, 1,500 submissions?
Yeah.
I mean, just out of Aon, we sent out over 350 deals to market. It's basically a deal a day. We bound 165 plus, close to $6 billion in limits. So these guys are hustling. There's a lot of activity. That type of overnight turnaround is just simply not possible due to manpower considerations. I mean, hopefully we're addressing that. Everybody's hiring and sort of staffing up. But I mean, there's more deals right now, frankly, than there are sort of people to service them. So. Let's talk real quickly, and Ben, maybe this is one for you, about strategics. We've seen increased use by strategics as opposed to private equity funds. I think the private equity guys really drove the growth of the business, over the past 10 years. We've seen increased usage by strategics over the past, year, 18 months. It's been very encouraging. What are your views on that?
Yeah, I think the first driver, right, is what we talked about before, frothy market. So strategics come in. I mean, it used to be that it was like, what was the access to the credit markets, right? If the credit markets were wide open, sponsors could compete with strategics. If they were tight, strategics had an advantage because they could just spend more because of all the synergies. So when the credit markets are healthy, well, they can compete. Now they're competing on how much risk the seller has, and so strategics in some ways have been forced to have to use this product. And it's the kind of thing that once you do it once, you're like, oh, it wasn't so bad. Right? But before you do it, it's like, wow, that makes me nervous, right? When you think about when you think about from the strategic perspective about what your incentives are versus sponsors who essentially get paid to take risk, it's a little bit different too, right? You're protecting your downside a little bit more. So using a product like this that's been untested, okay, that makes you nervous. You get forced into it. Folks get comfortable with it. Your investment committee equivalent gets comfortable with it, and then you use the product more and more. So I think that's been the major driver versus something kind of organic inside the strategic. Yeah. It's more like circumstance.
I try to, this is a joke I make in every strategic pitch that I do, but I try to tell our corporate clients, look, I know you have a playbook. Most corporate clients are accustomed to paying a little bit more for business and they'll ask for a little bit of a bigger, indemnity cap. So you can take your indemnity cap offer down from, completely obnoxious to merely unreasonable, right? And let the insurance be the sort of gap within there. Take it from 15% down to 5%. You don't have to be as aggressive as the private equity guys, but provide a reduced indemnity cap and buffer that with insurance on top of it, and you'll get a better result. So, and it's going to be cheaper, frankly, at that attachment point. I think we just have a couple minutes left. Any questions from the audience? Anybody want to lob a query or two up at us? Yeah.
Can you comment on size of transaction? Is there a lower limit?
Good question.
Yeah, so the question is size of transaction. What's sort of the lower limit in the current market? I would say a $5 million limit of liability is where most folks are drawing the line. AIG is probably not going to come to the table for a $5 million limit of liability these days, but we can get you quotes down at that level. That usually translates into probably a $30 million or so deal size, where the numbers make sense. We do have some carriers who are now focusing on sort of that lower mid-market. They're trying to develop a product that's a little bit lighter touch on underwriting. It's probably going to feature a little bit of a higher price and a little bit of a higher retention, but it's something that they can pump out, in a little bit more of an efficient fashion. They can't spend the same amount of time doing a $3 million, $5 million limit that they're spending on a $60 million limit. At the upper end, I mean, we have a lot of new capacity coming to the table. We did a $375 million policy this year. I'm pretty confident we could get up to 500 or 600 without too much trouble. There's always the potential to go to Berkshire as well, or somebody like that with an enormous balance sheet, but you're probably going to pay 25 cents on the dollar if we wind up calling a G chain. So we don't place too many of those. Other questions? Yeah.
Yeah. Environmental is always an issue in our deals because we're buying manufacturers, both site contamination possibilities and off-site. How are you doing that in terms of insurance?
Yeah,
that's a great
Do you want to
question.
take this one, Phil?
Yeah, that is a great question. I think the coverage for environmental on reps and warranties insurance has gotten much better over the years. I think a few years ago, you would just see blanket environmental exclusions, and that would be the extent of it. We're really getting a lot more tailored with the coverage. And so there's sort of two routes that you can go. One, you can seek out separate pollution liability insurance from carriers, which is going to probably get you a little bit a lower retention, and then we would sit above that. Or you can use the reps, and we would just work with you and understand your environmental due diligence. We would look at the phase ones that you performed, and we wouldn't be covering known conditions, but we would be providing coverage for the unknown things that you don't know about yet, unless it's a really, really nasty type of facility or something like that.
We actually have one of our best environmental brokers sitting right over here as well. And we, when you work with us on one of these deals, we coordinate with them very, very carefully. We coordinate very closely. I mean, we do a lot of deals where if there is a hairy sort of environmental situation, we'll coordinate with a PLL policy and a rep policy, above that. But I think there was a misnomer out there for a long time that environmental just was not going to be covered by a rep policy, and that's not the case. Any other questions? There's one back there, yeah.
Is there an interplay all between the actual text, the reps, and the ultimate price? Is there an incentive to make it more buyer-friendly for insurance?
Right. So the question is there an interplay between the text of the reps, like will tougher reps result in a higher price, I think is really the question, right? Or if you have a looser set of reps, will you get a little bit of a lower price? At this stage of the game, I don't think that there's that much price flex, to be honest with you. I think the carrier's approach would be if they see something in the reps that's way off market and that they can't cover, they'll exclude that piece, or that they might, for purposes of the policy, add in a materiality qualifier or knowledge qualifier or something like that. But I don't see too much price flex based off of a tough contract. Do you agree with that?
I agree with that. I think a lot of times we're pricing it before we really know what the reps are going to settle out on anyways. So it's sort of a portfolio approach. We're sometimes going to get deals where the reps are pretty seller friendly, and sometimes we're going to get reps where where they're really buyer friendly.
Yeah, I mean, the carriers have become probably the greatest aggregators of rep and warranty language and sort of standard deal terms these days. But within the context of deals that feature insurance, right? It's not a broad view of the entire market, but deals that feature insurance. I mean, again, we're looking at hundreds, if not thousands, of deals at this point per year. So.
You guys gonna start selling those deal terms now? Is that the idea?
Yes.
Hi. Now that you're starting to see some volume, what are you seeing on the after close and post close claims?
Great question. I thought we were going to be able to get to the end of this without discussing.
Yeah, what are we seeing? What's paying out of claims?
No, I mean, look, our experience with claims has been, good all in all. I mean, we've had some tough ones, we've had some easy ones, but I think that's probably the same answer you'd expect from any M&A practitioner, right? Working through a claim with a recalcitrant, seller on a deal. I think the misperception is that, making a claim against an escrow is like, just reaching into a cookie jar and taking out a cookie. Like it's not that simple. There's going to be a negotiation with any seller over any breach of rep claim and over any sort of, reduction to an escrow or holdback out of an escrow. You can expect that these guys are smart M&A people, so they're going to want to know that the breach has occurred. You're going to have to establish that the real negotiation is always going to be around quantum of loss, figuring out, what's the appropriate amount of loss that's flowed from that breach. And having the language that we have now, where we're not excluding multiplies, we're not excluding consequentials, that makes that discussion a lot better for the insured and a lot more challenging for Phil and the carrier.
But remember, like, the best marketing he ever can do is to pay out in a claim.
That's right.
Exactly. Yeah.
That's right.
And we're aware of that, and I work with our claims department every day. I speak with the folks in our claims department and make sure that they're on the same page as us as far as what we intended to cover and what we should be covering. And we want to pay out claims. We're not gonna be able to keep sitting up here and talking to you guys if we're not paying out claims at the end.
Everyone's very cognizant of our growth, within the industry. We're a fairly small group of folks who do this every day, and none of us want to derail it. The number one sort of opportunity to derail our progress and our growth is to have a couple of really bad claims experiences out there.
Yeah, and we don't like to give out too many details on what our book actually looks like. It's proprietary, but I can say that we paid out over 9 figures in claims last year. So we're paying claims.
That's globally, not just in the U.S. Yeah.
What is the difference in your business domestically versus particularly in emerging markets?
Good question. I mean, we are actively working toward more emerging market, coverage, and both on the brokerage side and on the underwriting side. I think at this stage you can probably, but for really, really challenging jurisdictions, you can probably get coverage just about anywhere. Globally, we'd have to find the right people within Aon to set you up with, and there's only a few carriers who have sort of that global footprint that can accommodate deals internationally. In the UK, EMEA, even Australia, pricing is a lot lower than it is in the US. Basically, less litigious environment. Their sort of common law approach to the actual knowledge exclusion that we were talking about before and what gets carved out on a knowledge basis is a lot different than in the US. It makes it harder to bring a claim over there. So their pricing is a lot different than ours. For more emerging markets, less established markets, I think you're probably, if there's coverage available, it's going to be from only one or two carriers, and your pricing is probably going to be a couple ticks higher than it would be on a U.S. policy. So instead of 3 to 4%, you might see 4 to 5 or 4.5 to 5.5.
But remember, in all these markets too, right, the way folks think about deals is differently, right? I mean, we're doing a deal now in the UK, and very different construct than what we have in a typical U.S. deal where there's a lot of volume. Sorry.
Well, thanks for the opportunity today, and we're happy to help with any deals you guys have in the hopper. So.
Thank you.